All right, good morning, cash flow zone traders. We are now into week 3 of the cash flow trading system. Today is Wednesday, November 28th, and we're going to be putting on our third trade of the program so far. Today we're going to be putting an iron condor together on Tsla, ticker symbol tsla. And so again, just as a reminder, as we get started today on this week's trade, as you are getting going with this, make sure that you have gone through the education modules so that you understand the concepts of the iron condor, how we manage risk, how we enter and exit the trades, how we build them, and the whole premise behind them. And again, repetition is always good. So even if you've gone through the modules once or twice, it never hurts to go through it once again. Secondly, in addition to that, we do want to get onto a trading platform that can do a couple of things for us. Number one, we want a trading platform that has advantageous commissions. And that's always a challenge, dealing with commission charges. Iron condors can be a little bit of a commission heavy trade because we have 4 separate transactions, 4 separate legs, all combining together into an iron condor. And so one of the things we want to focus on obviously is how can we minimize our impact that commissions have on our trading. Tastyworks is a great platform for that because we only get charged a commission as we enter our trades, and there is no commission as we exit our trades. Number 2, it's nice to have a robust trading platform that can do a lot of the work for you, and Tastyworks does that. We will be able to do an iron condor trade, all 4 of these legs going into the iron condor with one single push of a button. One single push of a button to get into our iron condor, one single push of a button to get out of our iron condor. And so again, there are many brokerage firms that you can use. A lot of the questions that we have coming in is, hey, I'm using Fidelity, or I'm using Charles Schwab, or I'm using this broker or this broker or this broker, and I'm having struggles, I'm having problems with getting the broker to allow me to set this trade up or do this trade. And that can be true. So while there is not necessarily one recommendation that we're going to give you of one broker over another, there's many brokers that you can do this trade at. Tastyworks is probably the easiest platform to do this on. Now, for those of you that are outside of the boundaries of the United States, that can present one additional little hurdle simply because Tastyworks is based in the United States. That's fine if you're based elsewhere outside of the United States. We just need to find a broker that works for your particular location. And so Interactive Trader is a brokerage firm that is international and does allow us to do iron condors. So check those out. But we need to get moving on to the Tastyworks platform. A lot of you have been able to get that done in the last week. Some of you are still working on moving to the Tastyworks platform. And so as we go forward today, I'm going to show you the trade inside of my options house trading platform again manually, but I'm also going to show you what it would look like inside of the Tastyworks platform as we try to start moving towards working exclusively inside of that platform going forward. So one other thing that we want to just mention as well, we should be practicing our trades as we go out and do these. And practice does make perfect, but we have to do perfect practice. And we want to make sure that any mistakes that we're making inside of a paper trading account. This is an account where we can trade real stocks and real strategies in the real markets, but without real money at risk. And so that's the proper way to learn a strategy. We don't want to practice, obviously, with real money. And there's a lot of places that we can go to get paper trading accounts or virtual trading accounts. One of the easiest ones, one of the most popular ones, is through the brokerage firm TD Ameritrade, and they have a trading platform called Thinkorswim. So if you just Google Thinkorswim paper trading, you'll pull up this login page here. You can register for a free paper trading account. They'll give you one of those for free for 60 days. And this is a great way to go practice our strategies as we get going with the cash flow system. So let's go ahead and let's take a look at what we want to do trading wise for this week. Okay, so first and foremost, we always want to do a top-down analysis as we build our trades. And we want to start by looking at the overall market. And we say the overall market, we generally refer to the S&P 500 is the one of the largest broad-based barometers of the overall stock market. When we say the market went up, the market went down, that's usually what we're referring to as the S&P 500. And there is an ETF that tracks that called the SPY or the Spiders. The ticker symbol is SPY. And that's an easy way to take a look at what the overall stock market is doing. And as we have recommended in our training, I am in the Ninja Trader free charting program. The Ninja Trader is I think a clean charting a program to be able to look very easily at what the overall market is doing here. And so if we look at this chart here of the overall stock market, we can come back a little in time here. Let's go maybe to the first of the year and we can kind of see what's happening in the market and where we've been. So just to refresh our memories here, we had a nice run up at the end of last year going into 2018, and then we sold off pretty precipitously at the first of this year. We had a lot of chaos, a lot of volatility in the first part of the year. During the summer months, we had a nice little rally back up. Things seemed to smooth out a little bit. And then October hit, and we've had a massive, massive downdraft in the stock market. We had a little bit of a sort of an attempted rally here, again, coming back into the 1st of November, but we've sold off pretty precipitously again. And so as you can see here, we're at about 268 on the SPY. That's actually lower than where we were back here in January of this year. So this is something that really speaks to the power of the iron condor trading strategy, a strategy that can allow us to make money in a neutral trending environment. We basically are flat to negative on the year. So if you were a buy and hold investor, if you were buying stocks this year, very likely that you are no higher than you were at the start of this year. But we look at all of this chaos and we do see sort of a defined range that we are trading in. And so now we want to go look at that and apply that to our stock that we are trading this week, and that is Tesla. And so again, one of the questions that has come up during our last couple weeks sessions is why are we trading individual stocks versus the actual indices themselves? And one of the things that you'll learn in trading is that if you don't like what's happening right now, just wait a couple of days because it will change. The only constant in trading is change. And as we said, one of the things that we're seeing right now with the indices, the example here being the S&P 500, is that we have a lot of volatility, and a lot of that volatility right now is to the downside. And that's something that we don't desire. That's something that we're not looking for inside of an iron condor. We are looking for something that is more range bound, something that is a little bit more steady. And so while the overall market right now is definitely in a downtrend, we want to see if we can find something else to trade, something that is maybe a little bit more range bound and consolidating. And Tesla meets that bill. Tesla, as we look at it here, definitely a volatile stock. We can come back here over time and see that Tesla definitely is a volatile stock. It definitely bounces around. But we also have some very defined trading ranges here. So if I can grab my crosshairs here and we can look at this, we can see that over time, Tesla, while it has bounced around quite a bit, has had sort of a very difficult time getting above this 350, 360 range. And it's had a hard time falling below this 260 range. So it definitely has a definable trading range. The current trading range, we could say, is somewhere between this 290 level and this 370 level. And so we want to go ahead and look at building out an iron condor for Tesla this week. So let's go ahead and put that trade together. Now, a couple of items that we want to think about as we are building out this trade. This week should be a fairly volatile week, or could be a fairly volatile week. We've got Fed Chairman Powell coming out today. This is Wednesday, with some specific announcements on interest rates. That's going to probably affect the market. As we sit here right now, pre-market, the futures are up, and it looks like it's going to be an up day, but we'll see what that speech brings to the marketplace. We have the G20 summit taking place, and that's going to impact what we're doing. So we've got Powell coming out with his announcements today. We've got the G20 summit coming up here. That's going to definitely affect the markets. We've got the crypto markets. We've got the cryptocurrencies that have really been volatile lately. They're crashing through the floor, and that's creating some issues in the marketplace as well. And then last but not least, this week, we've got some consumer sentiment issues coming on. And the consumer sentiment numbers are obviously what are very important for the marketplace. This drives the overall market, and we do have consumer sentiment falling for the first time in a long time. And so see, these are some of the things that we need to be looking at as we create the legs in our iron condor. How much safety do we want in our trade versus how much profit potential? And so remember that teeter-totter that we've talked about before, the difference between the probabilities of a trade, or in other words, maybe the risk of a trade, the probabilities of a trade working versus the profit potential. So there is this inverse relationship that we talk about. If we have a very high probability of success, we can experience probably a very low profit potential, and vice versa, obviously. If we have a very high profit potential in a trade, obviously if the profit is very high, that might mean that we have a very low probability of trade. Or in other words, the risk is higher in this trade. This would have a lot higher risk. And there's no right or wrong way to do this. We have to figure out what the balance of this needs to be for us. And so one of the conversations and a lot of the questions that some of you have had over the last couple trades is the concept or the idea of risk and managing risk. How do we control risk? How do you measure risk? And there's several answers to that. So as we talk about this concept for just a second here of risk, there are several ways to define risk in a trade. Now, the most common way that a lot of people will look at is just how much capital. How much capital are we committing to a trade? So in other words, if I were to commit, say, $5,000 to a trade, you would assume that you would have a $5,000 risk in that trade. Now, hopefully, as an educated trader, no one is trading this way. If you put $100,000 of your 401k monies into stocks, we're hopeful, obviously, that we would look at that and say, I don't want to risk all $100,000. It's never prudent to risk your entire capital. So the capital that we contribute to a trade should not equal the risk of the trade. Those two numbers are separate and distinct numbers. And the way that we calculate risk in an iron condor, one of the things that's nice about an iron condor, that we love about iron condors are what are referred to as defined risk trades. So when you buy a stock, when you buy a bond, really when you buy any type of an investment, we don't know what the downside risk in that trade is going to be. That is not the case with an iron condor. Iron condors do have a defined risk. We know right up front what the risk in that trade is. And not only do we know that, but we're the ones that structured it. We're the ones that decided what was acceptable and what was unacceptable. So the easiest formula to figure out what that defined risk in an iron condor is simply we take the capital that we put into a trade, the capital in the trade, and we divide that by the following. So we're going to take the money that we put into the trade, and we are going to look at the following measurement. Risk of the trade is equal to the spread of one of our legs minus the credit. The spread minus the credit. So if we put in, say, $5,000 into a trade, but we understand that's not what we're actually risking, that risk is actually going to be the difference between the spread and the credit that we receive. So if the spread, the difference between our legs on our iron condor, if the spread was, say, $5, and the credit that we received on the trade was 50 cents, let's say, that means that basically 50 cents minus $5, the risk in this trade is going to be $4.50 a share. So if this was a $100 stock, for example, we're not risking all $100 of that stock's share price. We're simply risking the spread minus the credit, or $4.50. So that's the benefit of a defined risk trade, is that rather than trading $100 stocks and risking all $100 of a potential loss, we're only risking $4.50. One last comment on defined risk. Remember that there is no trade, there is no investing approach that has zero risk. Every trade has risk. Everything in life has risk. Every time we leave the house, we experience risk. In fact, even in the house, I guess we could technically slip and fall in the shower. So there's always risk in life. There's definitely risk in investing. We never look for ways to eliminate risk, because that's not reality. What we can do, and what is always prudent to do, is to, number one, quantify the risk, and then number two, minimize it. And so that's what we do with defined risk trades like iron condors, is we, number one, quantify the risk, number two, we minimize it. And one of the things that we also want to do here, in addition to this, to even minimize this risk even further, is, remember from our rules, we're trying to find iron condors that we can build that give us maybe a 70 to a 90% probability of profit. So we're getting into trades at 70 to 90% probabilities of success. We want to exit these trades. We want to get out of these trades before the probability of profit falls to less than 40%. So if that probability of profit falls from 70, 80, 90% down to 40%, we want to get out of the trade at that point, or adjust the trade with some delta hedging at that point. So remember, we're going to even take this small amount of risk and mitigate it even more. All right, let's go ahead. Let's get into looking at Tesla, and let's build out this trade. Okay, so let's take an analysis here of Tesla and what we're looking at on the chart, and a couple of things to think about on this trade. So as we look at a chart of Tesla here, this should look familiar. We've seen sort of this trend over the last year. Tesla has been very active and fairly volatile. It's had some decent movements, but it's been contained within a pretty defined range. And so what we want to do here is try to define where we can create the highest probabilities of success with still allowing us a decent profit potential. And so a couple of things that you're going to notice here as we look at the chart of Tesla. Right now, as we speak, Tesla is around $344 a share. That's sort of the price range that we're working in here. And what I want to do is go out, first of all, and define our support and resistance areas. And so we have defined on the downside our support level of about 270. So downside support is around 270. Upside resistance is around 400. And so this trade is going to involve selling some calls at the $400 strike price and selling some puts at the 270 strike price. And then we are going to buy our protection back as well at the same time simultaneously. So as we sell these 400 strike price calls, we're going to go buy back some 410 strike price calls. As we sell these 270 puts down here, we're going to go buy back some of the 260 puts. So there will be a $10 spread between these strike prices. So let's write this down here so that we've got our numbers. 270 is our strike price on the bottom, and 400 is our strike price on the top. So as we go out to build this trade, I'm going to show this to you a couple of different ways. I'll show it to you manually, and then we'll merge into the Tastyworks platform, and you'll see how we get a little bit more information that's at our disposal. It's also a little easier to build these trades in the Tastyworks platform. But to do it manually, again, simply, we're going to look at Tesla, TSLA. We've already got that pulled up in here. Not too much movement here so far this morning. Let's click on our options chain, and we're going to come down here to this expiration date, the December 28, 2018 options. This is the last Friday of the year, last Friday of December. It's exactly 30 days out from where we are at right now. And let's go see if we can define these legs. So on the downside here, we're over here on the right-hand side looking at our puts. On the downside, we said that we were looking at the 270 strike price. So if we click on the 270s, let's just do one contract here for example purposes. That'll make it easy to scale for all of you. And again, one thing that I do want to reiterate here on this is another question we've had on the previous trading examples that we have given. Folks, remember, trading is scalable. It's one of the most scalable businesses out there today. It doesn't matter whether you're trading with $1,000 or $1 million. Every trade is scalable. And so we're going to use maybe an example in this Tesla trade of one contract. We're just going to trade one contract on each leg. But you could clearly do 10, 20, 50, 100 contracts depending on your brokerage account size, your risk propensities, and your ability to scale that trade based on your account balances. So just remember that trading is scalable. We want to talk percentages rather than dollar amounts, because 10% return is 10% return, whether you are looking at a $1,000 account or a $10 million account. And that's how we can compare apples to apples. And so we will use just, let's say, one contract example here. So we're going to sell this 270 strike price put. Remember, the order is not a buy order. The order is a sell order. We're going to sell one contract. It is the December 28 expiration. 270 strike price, and it is a put option, not a call option. So we always have to make sure, are we buying or selling? How many contracts? What is the expiration? What is the strike price? And what are we doing, a put or a call? So in this case, it's a put. So this is our downside leg. We want to sell those 270 strike price puts, and then we want to immediately go in and buy our protection. So let's do a one buy order of a contract, same expiration date. And we're going to go $10 below the strike price that we sold. So we're going to buy back the 260s. You'll notice that the ones that we're selling, they're bid at about $365, $370. The ones that we're buying back are around $3. So this is the concept behind a iron condor. we are buying protection at a cheaper cost than we are bringing in income-wise. Okay, so that's our downside leg. Let's go ahead and add our top leg to this. We want to now go sell. Let's make everything equal. One contract of the December 28 calls. And the calls that we were looking at here were the 400 strike price calls. So there's the 400 calls. And then, of course, we want to immediately go back, add one more leg to this trade, and buy our protection for that call leg. One contract, same expiration, $10 above. So there we go. We're selling some calls for around $2.43. We would be buying some back for $1.53. So the mid price on this trade is somewhere around $1.68, $1.65, somewhere in there. We might have to go as low as the bid price of $1.32, but we'd love to get somewhere around that $1.60 level fill price. If we look at this quickly in our snapshot, just one thing here that I do want to show you on our snapshot here, you'll notice that this risk graph shows us that this trade is not quite equidistant. In other words, we have a little bit more safety, a little bit more protection here on this trade to the downside leg, to the put leg, than we do to the call leg. This is one of the first unbalanced iron condor examples that we have provided. So again, we're just providing a little bit extra safety margin, a little bit extra downside protection to that put leg, to that downside leg. So this is the concept if we had to go in and do each one of these individually. However, let's take a look here at doing this trade inside of the Tastyworks trading platform, and you can see how much easier it can be to do this. Okay, so inside of the Tastyworks trading platform, you're going to see that there's a lot of greater ease in building out our iron condor. And not only is it maybe a little bit graphically easier to track and see what we're doing here, but we also get a lot of tools that give us some cool information as well. So as I log into my Tastyworks trading platform here, it's going to give us the options here. I want to look at the curve, which is what we refer to as the risk graph. And let's put in what we're going to trade, which is Tesla. I've already got that in there. I've already been looking at Tesla here. We put that in. We can click right here on strategies. Which strategy would you like to trade? And obviously there's a lot of different strategies that one can go out and trade on a stock. We, of course, are looking right here at the iron condor. And there's two types of iron condors. There's the iron condor that we've been doing, that is the normal iron condor. There's an inverted or a reverse iron condor. That's a different trade. And so we're just going to do a normal iron condor. We're going to click on the go button here. And it's going to give us our graphical interface here that we can start working with on building out this trade. So there's a couple of ways to pick and choose and build your trade inside of the Tastyworks platform. You can simply grab the calls and puts that you are looking at trading, and you can slide them up and down and change those locations. However, it's sometimes easier to just work with the buttons and do it automated. Now, one of the nice things that I like about the Tastyworks platform, you'll see right down here these dotted lines. We can see where that 1 standard deviation move is, that 2 standard deviation move. Remember, as we get closer and closer to a 2 standard deviation range, that gives us about a 95% probability of success, or meaning that there's a 95% chance the stock will stay within those ranges. And so let's go ahead and let's work on building this out. We have said on the call leg up here that we wanted to sell the 400 strike price calls. So let's go move this up here to the 400 level. There's the call that we're going to be selling. And then let's move the calls that we're going to be buying back as protection to the 410 leg. So we've got our upside leg here. We're selling the 400 calls. We're buying the 410 calls. On the downside, we said that we wanted to sell the 270 strike price puts, and then we wanted to buy back the 260s. There we go, the 260s. So here's our trade. Here's our iron condor on Tesla. And there's some of the numbers that we want to look at. As everything shakes out here, you can see some of the key components to our trade. This is about an 84% probability of profit trade, which is well within our defined range. Hopefully we can get a fill price here of about 86 cents on our credit. So we're looking for a net credit of 86, 87 cents, 88 cents. Somewhere in that range is what we're looking for, okay? Now, what type of order is it? It is a net credit trade. So we want to make sure that we're getting paid for this trade. So it is a net credit trade. It is a day trade. We want to just do it for the day. And then on our contract size here, we want to come down here. I'm going to pull this all the way down to 1 contract. And again, remember, trading is scalable. You can build this out at whatever level your trading ability provides for you. So if we look at this trade right here, a couple of things that it shows me on this trade says that my price, the cost, if you will, that this trade is going to require capital-wise for me is about $913. That's the capital for one option contract. That one option contract will bring in $87 of maximum profit on the trade. So just real quickly, again, 87 divided by 913. This will give us our profit potential on the trade. This is about a 9.5% profit potential on a 1-month trade. Annualizes out at almost 110, 120% a year. So that's not too bad of a trade. And so if we go ahead and send that order, that is your trade for this week. That is your Tesla Iron Condor trade. Folks, as always during the week, if you're having any questions, please make sure that you're looking at our weekly reviews as to how our existing trades, our past trades are doing and have done. If you have any questions at all, please submit your questions during the week, and every week I will answer those questions for you. Have a great week of trading, folks. We'll see you next week. One last note, folks, on this Tesla Iron Condor trade, if you look at the numbers here in the account, I actually went a little bit shorter on our duration rather than a 30-day trade. I wanted to shorten up our duration here, give us a little bit shorter time frame on this trade. You'll notice that I ended up using the December 14th expiration option. So rather than going out a month, we're basically going out 16 days. This is going to be a 16-day trade. This is a much shorter trade than we are used to. However, because of that, that's going to dramatically change our potential rate of return. Rather than bringing in that money over a 1-month period of time, we're only going to do that over a 16-day window. So that should be a much higher potential profit return percentage-wise. So again, we will be using the December 14 expiration date options. These expire 16 days out.